The day liquidity stopped flowing where it was needed. Liquidity is supposed to move silently. It flows where demand appears, smoothing stress before it becomes visible, until one day it doesn't. When that flow faltered, Europe's banks learned an uncomfortable truth. Liquidity is not guaranteed by design. It exists only as long as confidence allows it to move. To understand why this moment still matters today, we need to slow down, because liquidity failures rarely begin with shortages. They begin with hesitation. For years, Europe's financial system was built around movement. Capital crossed borders freely. Funding markets connected institutions instantly. Cash could be sourced, rolled, and replaced with remarkable ease. This fluidity shaped behavior. Banks relied less on deposits. They trusted wholesale markets. Short-term funding became normal, even prudent. As long as markets functioned, this was efficient. Liquidity appeared abundant. Spreads remained tight. Risk felt distant and manageable. But liquidity is not a stock. It is a relationship, a shared belief that money will be there when asked for. That belief rests on assumptions, that markets will stay open, that counterparties will remain confident, that uncertainty will always be temporary. When pressure appeared, those assumptions were tested, not through collapse, but through doubt. Institutions began asking quieter questions. Who might be exposed? Who might hesitate? Who might need liquidity at the same time? The answers were unclear. As liquidity slowed, behaviors changed rapidly. Banks reassessed every exposure. Funding desks shortened horizons. Cash became something to protect, not deploy. Markets reacted to these signals. Rates diverged. Collateral demands increased. What had been routine transactions now required reassurance. This shift created feedback. The more institutions held back, the more others sensed risk. Hesitation spread faster than information. Central clearing did not prevent this. Shared infrastructure moved transactions efficiently, but it could not create confidence. It reflected sentiment rather than stabilizing it. Cross-border channels were especially affected. Liquidity retreated toward home markets. Familiar counterparties felt safer. Geographic fragmentation reappeared without policy barriers. Banks with strong fundamentals still struggled. Access depended on perception, not balance sheets. Signals mattered more than solvency. Speed mattered more than fundamentals. Attempts to reassure markets were careful. Communication intensified. Facilities were announced. But usage itself carried stigma. Drawing on support signaled weakness. Avoiding it increased pressure. Liquidity became both lifeline and liability. The system entered a delicate phase. Money existed, support existed, but trust moved unevenly. What made this moment dangerous was not panic, but the absence of automatic flow. Each transaction required judgment. Each judgment slowed the system further. Liquidity, once invisible, became the center of attention. And when a system begins watching liquidity closely, it is already under strain. As hesitation hardened, pressure intensified. Liquidity stress stopped being episodic. It became structural. Banks adjusted operations. They increased buffers. They reduced reliance on volatile funding. They accepted lower returns in exchange for certainty. But these adjustments came with consequences. Credit availability tightened. Market depth thinned. The cost of liquidity rose across the system. What once moved freely now required incentives. Rates adjusted upward. Collateral standards stiffened. Time itself became expensive. Central banks stepped in decisively. They expanded lending operations. They widened eligible collateral. They signaled commitment through scale. These actions stabilized markets, but they also changed expectations. Liquidity support was no longer extraordinary. It became part of the landscape. Banks adapted to this reality. They planned around facilities. They treated central access as predictable. Private markets remained cautious. This altered the system's rhythm. Market-based liquidity retreated. Official liquidity advanced. The balance shifted quietly but permanently. Coordination improved. Stress was managed, but spontaneity disappeared. Flow was replaced by control. The system survived, but it learned a different lesson. Not how to circulate liquidity freely, but how to ration it deliberately. This created resilience of a kind, but it also embedded dependence. Markets learned to wait for signals. Banks learned to rely on backstops. Liquidity no longer flowed because it could. It flowed because it was permitted. And that distinction would shape European banking. Long after the immediate pressure passed, what the liquidity crisis exposed was something fundamental about the nature of money itself. Money, in modern finance, is not primarily a physical thing. It is a relationship, a set of mutual expectations about who will accept what, from whom, and under what conditions. When those expectations are stable, liquidity is abundant, not because reserves are large, but because a chain of mutual acceptance runs without interruption. When those expectations become uncertain, liquidity vanishes, not because reserves disappear, but because each link in the chain begins to hesitate before extending the next one. Europe's banking system, in its integrated form, had created an exceptionally long chain. Capital moved across borders. Institutions extended credit to counterparties in countries they had limited direct knowledge of. Funding markets connected participants who shared a currency but not a government. And the chain held, right up until the moment it didn't. The hesitation that produced a liquidity failure was not primarily about solvency. It was about information, or rather, about the absence of reliable information at the moment it was most needed. In normal times, relationships substitute for information. You lend to institutions you know, have dealt with before, and trust. The integrated European market expanded lending beyond existing relationships. It relied on price signals and regulatory frameworks to substitute for familiarity that local markets once provided. That substitution worked when prices were stable and frameworks were trusted. When stress appeared, it stopped working. Suddenly, institutions needed information they did not have about the quality of assets held by counterparties they had funded through market channels, about the sovereign exposure embedded in balance sheets across borders, about whether official support would arrive and in what form and for which institutions. Without that information, hesitation was rational. And rational hesitation, multiplied across thousands of transactions simultaneously, produced exactly the kind of systemic liquidity failure that no individual institution had intended or desired. That is the mechanism worth understanding. Not greed, not negligence. Rational actors lacking information, making individually sensible choices that collectively produce an outcome none of them would have chosen. The lesson is not that integrated markets are fragile. They are, in some respects, more resilient than fragmented ones. But integration without the information infrastructure to match it creates exactly this kind of exposure. The long chain holds when information flows freely along it. When information stops, the chain breaks at its weakest link. And in an integrated system, the weakest link is always the relationship that traveled farthest from existing familiarity. That relationship was not wrong to form, but it required more infrastructure than Europe had built before building the chain. That infrastructure is what the subsequent decade of reform attempted to construct, slowly, partially, under ongoing pressure, with results that are better than what existed before, and still not complete enough to prevent the next hesitation from triggering the next silence. At the most difficult moment, when liquidity is needed most, and the chain, uncertain of itself, pauses again. So what do you think? Are we repeating the same mistake again? That pause is where the story of European integration and European banking converges on its most important unresolved question. Can a system built on trust sustain itself when trust is hardest to maintain? In calm times, the answer appears to be yes. In stress, the answer depends on everything that was built before the stress arrived. Every reform, every framework, every shared institution is an answer to that question, delivered in advance, an investment in the chain holding, at the moment when the hesitation is strongest, and the work of building that infrastructure is never finished, because trust, unlike capital, cannot be accumulated in a vault. It must be continuously maintained, through consistency, through shared experience, through the demonstrated willingness, over time, to support the chain even when supporting it is costly. That willingness is what liquidity actually is. not a reserve. A relationship sustained by choice, every day, including the difficult ones. The day